As their name suggests, these are funds investing in stocks. The value of a stock fund is most likely to be volatile and inconsistent in the short term, primarily because prices are dependent on the underlying business and the economic dynamics. However, in the long run, stocks tend to outperform the other types of investment. There are different types of stock funds based on the risk and the potential profit on the stock they choose to invest in. Fixed income funds' primary objective is to focus on buying fixed income securities like government bonds, obligations, and corporate bonds. The aim of these funds is to provide their investors with a monthly income generated by the interest the bonds earn. This type of investment is very common among the elderly and retired because it's safe and guarantees a stable additional income. Is it risk-free? Nothing is. For example, prices of bonds depend on the movement of interest rates. If rates go up, bonds go down. Another risk is the borrower defaults on their payment. Income funds' main goal is the provision of income. That's why they invest in stocks that would pay a regular dividend. Index funds invest in portfolios of stocks designed to mirror and track the performance of a particular market index, such as the Nasdaq Composite or the S&P 500. The stocks are interconnected with the index, and their performance is entirely dependent on it. Many people prefer it due to its minimal management costs and fees. Usually, this type of investment is considered a passive one because a fund just purchases all shares making up an index. There are a couple types of stock funds. Growth funds invest in undervalued small-cap companies with above-the-average growth because their primary goal is capital appreciation. Value funds invest in stocks of companies that are considered undervalued because they want to have a greater safety and potential for appreciation. Blue chip funds' main goal is income and safety. That's why they invest in well-established and financially solid companies. Sector funds invest in a particular area of the economy or an industry, such as technology, healthcare, real estate, agriculture, etc. These funds usually offer higher appreciation potential, but there's also a higher risk involved due to the lack of diversification. However, some investors choose to put their money on them on account of their specific knowledge in the sector, or they could predict its bright future. There are many sectors of stock funds. Let's cover some of them. Green funds offer an investment in green and environmentally friendly companies, e.g. renewable energy sector. Even though they avoid investing in conventional companies with a less environmentally friendly attitude, it's arguable if they yield returns worth investing. This investment scheme has a more symbolic value than a real one, representing a more socially and environmentally responsible approach. Cyclical funds invest in stocks whose value is driven and affected by the economic ups and downs. For example, enterprises that are hugely dependent on discriminatory spending, such as hotels and airlines, tend to see their stock values rise when the economy is strong because people have greater spending power. And vice versa, when the economy is weak, people cut spending that's deemed unnecessary, which leads to lower earnings for businesses that sell discretionary items and services. This, of course, results in a decrease in their stock value. Qualified dividend-paying stock funds are mutual funds which invest in companies whose stocks distribute their shareholders a qualified dividend. This is yet another low-risk, passive investment opportunity. Therefore, these funds suit primarily retired individuals due to the stable income they offer. But this is not the only reason. Often the taxes imposed on the dividend are lower than the fees one should pay when withdrawing from their retirement account. In composition to bond funds, these are not as profitable but have a greater potential for increase of the value of their asset. As an example, Goldman Sachs Growth and Income Fund is currently yielding about 1.5%, but its total returns through October 31, 2006 is 17.5%. On the other hand, foreign companies often pay a higher dividend, which encourages funds to invest in their stocks. That's it for now. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We'd love to know your thoughts, so feel free to share them on the comments below.